Hello and welcome back to another edition. And today we're going to cover what college fund options that we have, all right? And I know that, when we're thinking about college, we're thinking about, a huge expense. It's amazing how people don't even think about how expensive college is or how expensive college has been, over the past couple of years, and it's only skyrocketed. There is a recent study that looked into how much people or how much students owe in student loans, and it's amazing. The numbers are mind-boggling when you think about it. When you look at the debt ratio, for students that are just coming out of college, and the pending loans, it's mind-blowing when you think about it. All right, if I'm not over exaggerating, I think student loans is the largest debt that exists in the United States. Right, when you just look at the numbers, they're just out of this world. So what are your options when you're thinking of your kids? I know most of us are already older. We're already in our 20s or 30s or 40s and 50s. Most of us already have the student loans. All right, most people already have the student loans. So when you're thinking of the next generation, because as it's painful to say, but some of us are already in that pothole, and it's hard to dig ourselves out of it. So when I'm talking about college funding here, I'm talking mostly to the next generation, our kids, the younger ones. How can we prepare for them to go to college without having to take a bunch of thousands or hundreds of thousands of dollars in student loans? We're talking of an average 4-year degree heading to the $50,000 and up. So how can you mitigate all of that? So when we're thinking of what options are available, I'm going to talk of only two. I know there are multiple other options out there, all right? I'm going to do some more research and get back to you, but this is the most common. Most parents probably have a 529, what is called a 529. It's a tax code, by the way, right? It's an internal revenue code that, just goes for a college plan. Now, most people settle for a 529. Banks offer it, credit unions offer it. There are other, financial institutions that offer a 529. Now, I don't know how many people actually dig deep into understanding what a 529 is, the advantages and some of the limitations or the disadvantages, if I may put it, that come with a 529. I know that it's very fancy when this banker or whoever is educating you or telling you, how a 529 works. Of course, they only keep it juicy, or they only keep the positives, ahead. But I want to take out some time and just dive a little bit, not extreme, but a little bit into how a 529 actually works. All right, just for your understanding. Now, a 529 is a tax code, like I mentioned, so there are some tax advantages that come with that, right? Some of the tax advantages that come with a 529 is the post-tax money, because remember, the money you're putting in a 529 is already taxed when you get paid from your job or wherever you're getting your wherever your source of income is. So that before you put it into a 529, it's already taxed. So when the money goes in there, it grows tax deferred. It grows tax deferred, but when you distribute that money, right, when you take the money out, depending on what you use the money for, it could be tax-free. All right, depending on what you use the money for. If you use the money for school and school alone, if you use the money for school supplies, if you use the money for tuition, if you use the money for board and for boarding school, if you use the money for anything for school supplies, that could be tax-free. All right, that could be tax-free. So those are just some of the tax advantages that come with this tax code right here when you have your money growing, sitting in there. Now, the second advantage, is the growth potential. The growth potential, right? We're going to break down what the growth potential actually means, which means it basically translates to how your money grows or how the funds in this 529 actually grow. All right. So that is seemingly the second advantage, how your money grows, and of course, how it's invested in the market. Bear in mind, the money in a 529 is invested in the stock market. All right. So we're going to look a little bit more on how that actually works, but it's an advantage. At least your money is growing. When you compare this option to a regular savings or checking account, you now see the significant difference. So you'd rather have your money comparatively growing in here at about 2% or 3% or 4% compared to a 0.09% in the savings account or a 0.05% in the savings account. All right, so that is kind of an advantage. Now, when it comes to flexibility, this is one of the advantages, flexibility. That's how liquid is your money. When can you access it at one point in time? all right? The money sitting in a 529 can be accessed at any time. It can be accessed at any time. But now, depending on what you're using the money for, it could be advantageous or disadvantageous, all right? It can be accessed at any time, meaning if it's accessed for school, for college, or for education purposes, it's, you can be accessed at any time. But you can distribute that money for any other reason. But now you're gonna, incur some penalties and taxes. We're gonna talk a little bit on that. So it is liquid. And to an extent, the money sitting in your 529 has a degree of impact to the financial aid that your child gets, or some scholarships. It has some degree. It says the impact is not significant, but again, right? It is kind of advantageous to that fact that it doesn't just totally eliminate your child, but it has some, impacts to how much your child can qualify for, if at all they can qualify, because the account is on the parent. The child can somehow go, without, having to incur some drawbacks. Okay, we're gonna look a little bit into this part. So these are some of the advantages that I found. All right, there may be multiple or more, but these are the most significant that I found. And of course, we're going to talk a little bit about the growth potential, because that is where the bulk of my concentration was. Because I'm looking at how can you actually guarantee that your child is going to go to college, that the money you are putting into this account every single month is actually working for you and not against you. All right, that is my main area of focus. How does your money grow in this account? Right, I'm a huge believer in Warren Buffett's theories or principles of money. His first rule is make money, never lose money, and his rule number 2 is never forget rule number 1. So in every single research I do, I'm always looking at this. This is my main point of focus. How can you guarantee that you're not losing money in this account? All right. Now these are some of the disadvantages. These are just some of them that I could find. All right, there are multiple, but this is just some of them. The money in your 529 is not guaranteed. That was a huge blow for me. All right, so the money you keep pumping in the 529 is not guaranteed. Guess what? The money in your savings account is more guaranteed than the money sitting in your 529, because the money sitting in your savings account or checking account is guaranteed, at least it's backed by the Federal Deposit Insurance. I forgot the last word, right? But guess what? Your money is guaranteed up to $250K, which means if that financial institution goes bankrupt, they would refund. This Federal Deposit Insurance would refund your money up to $250,000 if it's sitting in a savings or checking account. But if your money is actually sitting in the 529, you get $0. So you have the potential of losing your money, plus your principal, plus everything you're paid into that account. All right, so it's not guaranteed. That is the one big drawback for me that I found. All right, so you could lose everything if that institution goes bankrupt. That's one thing to take note of that. All right. The second disadvantage I found was it's depending on what state you live in. Depending on what state you live in, the account functions differently. All right. I also learned that in some states, Minnesota included, you could actually have some tax advantage. Like to a degree, you could write off the distributions you put in a 529. All right. Now that is for some states. I found about 6 or 7 states that you could actually do that in. Most states wouldn't give you that leverage. So depending on what state you live in, you want to find out how a 529 works in your state. So it's not general. All right. The third disadvantage I found here was if you distribute the money in a 529 prematurely means it's not yet time for the child to go to college. If you have a family emergency, you have a car emergency, medical emergency, whatever emergency it is, and you decide to distribute money from your 529, you could get up to a 10% tax, and of course, a 10% penalty, and you could incur some taxes if you distribute the money for anything or for any reason but school or education expenses. All right, or school supplies or boarding, anything that has to do with you taking money out of your 529, without it going towards an education purpose, that those funds, you can incur a 10% penalty and taxes, of course. All right. Now let's come to the big one. The big one here is how your money is actually invested, how your money is actually grown, right? That is the big one. Well, that's my area of focus. And when you deposit whatever funds you deposit, it could be $5, could be 20, could be $100 or $200 or $500 in a 529, this is what is happening in the back end. Your money is invested in stocks and bonds. Now you have the advantage of choosing how you want your money to grow. All right, so you could choose to have a 50-50 balance, which means half of your money is invested in stocks and half of them is, half of the funds are invested in bonds. Now, bonds are not as volatile, so they're not dancing up and down like stocks normally do, so they are more stable. Of course, more stable means that you're not that your returns are going to be, of course, diminished as well. You invest in stocks if you want to be more aggressive, if you want to grow your money. But of course, the more you invest in the stock portfolio, it means your account can dance up and down, and you have the potential of making more or the potential of losing as much as well. All right. So the money sitting in your 529, let's say your child was 0 years old. From the day your child was born, you open the 529 for him or her. And the intention is by the time they get to 18 and ready for college, you have enough money saved up in here to fund a $50,000, $70,000, $100,000 college. All right. So the money you have sitting in here could grow this way. Now take note, I'm trying to be a little bit realistic and be like, okay, in 18 years, I know that the market is going to appreciate, but it's also going to fall, at some point. All right. So your account grows at the pace of the market. If the market keeps dancing up and down, your account grows in the same way. If and when your child decides to go to college, your account is going to be at the rate the market is. So if at 18 the market is up, your account is going to be up. If at 18 your market is down, your account is going to be down. Now the good part is you can also adjust the proportions in terms of stocks and bonds, right? You could always readjust it. But again, the fact that the money growing in here is not guaranteed, and the fact that you have the potential of losing money, that is a red flag. All right. If we're going with Warren Buffett's rules of make money, never lose money, then you have the potential of losing money in these instances. All right. So the money in there is not guaranteed, which means you could wake up one day, the bank or the credit union or whatever financial institution you're saving your 529 at disappears overnight, and you have no insurance or no guarantee on how you can get back your funds. All right. So you want to make sure that you're looking or you're reading, in between the lines, understanding what you're getting yourself into, understanding how you're planning for your kids' college, how you're planning for the future. Don't just get it because someone told you to get it. Don't just get it because you heard people getting it. You want to get it because it actually works for you and your family. Now, what are the alternatives out there? Like I mentioned, there are multiple ways you could grow your kids' college fund. All right, multiple ways. Now, one of the solutions I offer my clients, one of the solutions I offer a lot of families, is one that I've come to understand. I've researched, I've worked, and I've heard multiple people get accounts like this for their kids, and this is just because it is more guaranteed. I live by the golden rule of never lose your money. All right, so I deal with flexibility and deal with longevity. All right, so we're looking at something like this. All right, take for example, if you had the chance of growing your kids' college fund in a more guaranteed and secured way, wouldn't you want to explore that option? And that is what I ask of everybody. Be open-minded enough at least to explore all the options that are out there. Right? It happens that instead of using a 529 tax code, you could actually use another tax code called a 7702 tax code. All right, these are both tax codes. Now, how your money behaves in a 529 is what we just explored. I'm going to make a detailed video just explaining how your money actually grows in a 7702. I'm just going to give some highlights. With the 7702 accounts, the money you put into this account that could be designed to at least to mirror your child's future, or could be designed to maximize returns, right? The money you put in there is secure, it is guaranteed, which means that you can't lose your funds overnight. And of course, you are sure that your funds are going to be growing along your child's age. All right. So you have a bottom line of the minimum you can ever make into that policy, depending on what strategy you end up designing. But you also have you also have the potential of never losing your funds. All right. When we drew the map earlier, the graph earlier for a typical 529, it looks something like this. All right. I don't want to be exaggerating. It looks something like this. So you have the potential of making money for a couple of years, and by the time your child gets to 18, could be up here or could be down here, right? You get whatever is in there. Now, when you compare this and that, you're sure that your account is always trending upwards, regardless of what is happening in the market, right? So talk of bonds and stocks right here, not keeping the funds in this account stable. Here you're dealing with index funds. All right, you're dealing with index funds, and these, the way they function is very different from how a typical 529 would function. All right, so I'm going to make a detailed video just explaining how you could use a 7702 tax code to design a more guaranteed, college fund for your kids. All right, today was dedicated mainly for 529, exploring what a 529 is and seeing how you can actually, either use it for your family or for your kids, or at least consider a different tax code. All right. Until then, I wish you good luck. If you have a 529, or someone who has a 529, or someone who is looking into creating a college fund that is sustainable, that is secure, that is at least guaranteed that their kids are going to go to college, reach out to me, text me, call me, comment your video, and of course, I'm going to make sure that you get the help that you need. Thank you very much, and have a blessed day.